All right.
Hi, everyone. Welcome to Small Talk. Well, joining me today, and not for the first time, it's a mortgage agent. And I think he's also an investment counselor, but we can discuss that. Jason Wodlinger, is that how I
Wad
pronounce it? Wodlinger.
Wadlinger, yeah.
Wodlinger. Okay. So how you doing, Jason?
Good, good. Thanks so much for having me. It's a pleasure to be back again.
Oh, I'm glad to have you here. There's so much to discuss, especially when it comes to mortgages, right?
Yep,
Uh,
yeah.
One of the first thing I was thinking about is like when the Bank of Canada sets the interest rate, how does it affect mortgage rates?
That's a really great question because people seem to think as soon as the Bank of Canada lowers interest rates, and remember, tomorrow they're going to announce what they're going to do, which we all assume they're probably going to lower. Mortgage rates don't follow immediately. In fact, sometimes it can take 2, 3, or even 4 weeks before. In fact, as strange as this sounds, sometimes rates rise, like mortgage rates go up, even though Bank of Canada rates have gone down. There's a lot that goes on in the economy. There's a lot happening with tariffs right now, a lot of uncertainty about inflation, a lot about the economy. The Canadian economy is taking a big hit because of all of the tariffs that are happening. And so sometimes the Bank of Canada may still lower rates, but not necessarily mortgage rates don't follow immediately, but usually they do shortly after.
Right. One of the things that you mentioned is like the tariffs. So that's another thing I was thinking about. How does that, with what's going on in the US, how does that affect mortgages here?
Yeah, I mean, I'm not an expert certainly when it comes to economics, but at a hundred level foot view, um, when tariffs affect the productivity and the ability for companies to make money and to grow their revenue, they start laying off employees, and as soon as they start laying off employees, people start to find financial difficulties, and that's where mortgage agents come into play. To be perfectly honest with you, it's that as the economy starts to become uh, problematic. And growth starts to be limited because of tariffs. That's when companies make decisions about their employment and labor, and people lose their jobs, and financial problems start to occur.
Okay. Now that's another good point. So okay, so here you are, you have a mortgage, but now you're running your interest, sorry, your payments are you're having trouble making your payments. You don't
Yeah.
want to lose your house. What do
No.
you do?
Yeah, so a lot of the people that call me these days are come to me to say, I've got a job right now, I've got a lot of bills, and right now my income is exactly the same as my bills. So money comes in and then it immediately goes out, and I have no buffer and I have no cushion of safety. And when you're in that position, that's when you have to start thinking about consolidating your debt. If you wait for a potential problem to become a big problem, that's when it's not too late, but that's when you've got to move into like critical mode. So if a lot of people call me and say, I have no buffer, I have no problems, but if something goes wrong, if I lose my job, I am going to have a problem. And if you come to a mortgage agent before any of that happens, that's the best time to prevent problems from occurring.
Okay, so what are some of the things that you can prevent?
Yeah. So, for example, debt consolidation is simply just taking high interest debt and moving it into a smaller interest debt. So, mortgages are one of the lowest interest rates for all of debts, and credit cards are one of the highest. And payday money loans from Money Mart and whatnot, organizations that do quick payday loans, those are one of the highest interest rates. So, if you take all of the debt that's a high interest rate and you move it into your mortgage, now you have one payment and you have a low interest rate that's being applied across all of your debts. Your cash flow goes up, and with increased cash flow, now you can start paying down your debts because the number one thing you want to avoid is hurting your credit score. It doesn't matter how much money you have. If you have a bad credit score, that is extremely problematic. And I know a lot of clients who have a lot of income. They're very high income earners, but their credit scores are bad because of various things that happened. I almost can't help them because of that. So your credit score is one of the most important things in your financial health.
Right. It's kind of interesting, recently I was talking to a young woman who wants to save to buy a house, and she said, "Oh, you only have to put in a down payment of 10%." My thought of that, and I said to her that that's setting yourself up in a way. 10% is nothing. Like, what are you paying for a house nowadays? You're paying 400, 500, $600,000 and upwards, right?
Yep.
So
Yeah.
10% will give you a great big mortgage payment every month.
Yeah, like I always, my clients always ask me, should I use all of my savings for a down payment or should I leave some of my savings for emergencies or for living expenses? And my answer usually is it's a bit of a combination of the two, right? You do need your savings for emergencies, both life emergencies and house emergencies, but you also don't want to have that much debt that it's going to cause a major problem. Some people seem to think that if you can get even 5% down, that you're going to save all your money. But to your point, Nancy, you're going to have a massive debt that you now have to service for the next 25 to 30 years. And I'm always, even though my job is to help people use debt, I always advocate for as little debt as possible. That's always the best route to take.
And most mortgage are like what, 25, 30 years over that
Yeah,
period?
yeah, exactly. You can even get some are 35 years. But again, the longer the amortization, the longer you're increasing the amount of time it takes to pay back that debt.
Right, because basically you're hitting a lot of when you make your payments every month, like how much of that goes on to principal?
Great question. So the way it usually works is in a 12-month period, you have one payment. Let's say your payments are $2,000 a month. That $2,000 goes partly to interest and it goes partly to the principal. The question is how much goes to interest and how much goes to principal. In a 12-month period, the majority of your payment is going to the interest for the first few months. And then as the year progresses, the amount of the proportion that's going towards your interest starts to decrease and the amount that you're putting towards your principal starts to increase. So at the end of a 1 year term, for example, almost the majority of your payments are now going towards principal. So it's people don't actually know that, but that's actually how it works from a bank point of view.
Yeah, I didn't know that. How beneficial would it be to make an extra payment every once in a while? Or can you do that without a penalty?
Yeah, great question. So most banks will allow what they call 15 to 20% of the remaining balance to be paid either as a lump sum payment. So if you have a $100,000 mortgage and you're allowed 20% to do this, you can take $20,000 and you can put a lump sum payment, or you can ask the bank to increase your payments by $100 every month, and that $100 will only go towards your principal. And again, those are called accelerated payments. And again, as long as the accelerated payments are not more than 15 or 20% of the balance, it's a great way to pay down your debt.
Okay, right. Now, what's the difference between a mortgage renewal and a refinancing?
Yeah. So a renewal is when your mortgage comes to an end. Like most people have mortgages that are 3 to 5 year terms. When that term is ended, if you want, obviously you want it, you need to renew your mortgage unless you're paying it all off. If you're not paying it all off, you renew it simply by taking the exact same amount and moving it to either a new lender or just renewing your mortgage with the same lender. A refinancing is when you increase the mortgage. So if
Ah,
your mortgage is $100,000 on January of this year, and next January, it's now $80,000. If you don't change the amount, if you leave it at $80,000, that's called a renewal, or they also call it a switch. If you increase that $80,000 to 100 or 120, let's say you have some debts you want to pay off, that's called a refinancing. It's a very different process. It involves a lot of different things that need to be done. It's very different from a renewal or a switch.
right, for sure. So, do you have any tips for people who are self-employed and they want to buy their first house?
Yeah, so a lot of people are self-employed, right? A lot of folks are out there, and a lot of our economy is driven by small business and entrepreneurs. And so, one of the things that people like to do who are self-employed is to reduce their taxes, and they do that by writing off a lot of expenses. So, if you work from home and you have a mortgage, or if you have expenses or insurance, or even if you have internet, a portion of those costs are related to your business. Most people will probably write the entire internet cost off, right? Because they just want to write the whole thing off, when in fact they should only be doing a portion of it. But a lot of people will write off a lot of expenses that reduce their income, so that when they have to pay tax, they pay tax on a very small amount of income. The problem is some banks will only look at the revenue that you report to Revenue Canada. So if you make $100,000 and let's say you're a construction worker and you don't have a T4 or a salary, if you make $100,000 but write off $80,000, you only pay tax on $20,000. The problem is the bank will only think that you make $20,000. So we work with different lenders that understand this, and they have programs set up that allow a self-employed person to declare all of their income, even though they wrote off a lot of expenses. They can declare a lot of their income, and the bank will use that as their income. So if you make $100,000 and your expenses are really only $20,000, well, then you make $80,000. You may have told the bank, you may have told the government that you only make $20,000, but the bank knows you made $80,000. So that's an interesting tip. And again, that's something that a mortgage agent can sort of help you figure out who to go to sort of get that kind of thing to happen.
Right. One of the things I see an ad for, is it called reverse mortgage?
Yeah. Yeah.
What exactly is that and how beneficial is it or is it not?
Yeah, and to be honest, Nancy, that's actually a good question for an entirely different for a whole interview actually, because there's so much to
Oh,
reverse mortgages that I won't take up your time now. But suffice it to say, basically, it allows someone to take out, I think it's about 50 to 45 to 55% of their house value as reverse mortgage. You automatically qualify as long as the equity is there in your house, and payments aren't even required. It's an interesting way of dealing with cash flow problems in a way where you don't have to qualify from an income point of view. But there's a lot of things to it, and there are some people there are some pros and cons to doing a reverse mortgage. And if you have me back, I'd love to talk more
yeah.
about that in detail. Yeah.
I think what we'll do is we will have you back. Now you're in Ontario, correct?
I'm in Ontario. I sort of work all over Canada, but primarily my clients are in Ontario.
That's what I was going to ask you. Like you can, if somebody and say I'm in British Columbia, so somebody here wants to contact you and ask you questions about the mortgage, their mortgage or whatever, they could do that, right?
Yep, absolutely. Yep, yep. So I work with many people across Canada. So if somebody has a mortgage in BC, I work with colleagues together and we make that mortgage happen in BC. So we work everywhere. Um, but as I said, like if I because I my license is for Ontario, when I work in other provinces, I just work with other agents alongside me in collaboration.
Right. So what when you have when you're buying a house and you're using a real estate company, they sometimes recommend mortgage companies because they're familiar with some of them, I would imagine, right?
Yeah, yeah, yeah.
Is that a good thing for somebody who's buying?
Real estate agents are like they are working day and night trying to help people find houses, and
Mhm.
they know who the mortgage agents are out there that can help for certain situations. And a lot of real estate, I work with many real estate agents, and they recommend me when they think that there's a client that can benefit. They don't always, sometimes they recommend me for refinances, which is not something a real estate agent actually deals with. A real estate agent only deals with buying and selling. So, but a real estate agent is a great way to find a good mortgage agent for sure.
Yeah. So if you trust your agent enough to buy a house, using them to buy a house, you should be able to trust
Yeah.
them enough to go, take their suggestion for a mortgage company.
That's exactly it. And also because the mortgage agent is known by the real estate agent, they probably work together. And as you know, buying a house requires a mortgage usually. And so the mortgage is all part of the whole process. So having a real estate agent who's almost partnered with a mortgage agent is a great way to get something done.
So how do mortgages companies, so, what do I want to say now? Put their interest rate. Like is
Yeah.
who decides mortgage rates?
Yeah, so basically, the bank will look at the Bank of Canada prime rate, and based on that, they will increase their mortgage rate so that there's a profit there, obviously, because some banks are paying people interest rates for savings, and then they're charging people interest rates for loans. So they have to charge people a higher amount so that they can help pay for the people who have savings. That's how it all works. And so the bank will figure out, what is our risk tolerance? Do we want to help people who only have the best credit and the best income, or do we want to help people who have a bruised credit score and have challenged income? And so the interest rate will go up and down based on the risk profile of the client, as well as the type of business that that bank wants to go after. Like I work with hundreds of banks, right? It's not just the big five that everyone knows. There's a lot of alternative lenders out there, a lot of private lenders, and it's all about risk. If you're a borrower who has a bruised credit score and a challenged financial history, you're going to pay a higher interest rate because you're perceived as a higher risk.
Okay. Now, what do you mean by bruised?
Yeah, bruise would be like, generally speaking, 680 and above is a really good credit score. 600 to 680 is okay. You can still get mortgages. You can even get a mortgage if you have something below 600. It becomes challenging after that. But if you get below like 550, 540, that's where it starts to become very, very problematic. And at that point in time, my recommendation to people is fix your credit score. Like, don't go and buy a house, don't refinance and get more debt. Just focus on getting your debts, paying your debts, not missing payments, paying on time, trying to lower the amount. If you've got a $10,000 line of credit and you've used 9,000 of it, that's called high utilization, and you want to lower that. So you really want to focus on getting your credit score up, because once you get your credit score up, you have access to a wide range of interest rates and a lot of lenders.
So, okay, I'm just sorry, I've got all these thoughts in my head.
Yeah, yeah.
So you're a young person, you want to save for a house, but in the meantime, you have car payments. Now, is it advisable to get those car payments paid off first and then use that money that you would have been putting for your payments towards saving for a house?
Yeah, I mean, look, cars are expensive, right? A car can be $25,000 or $50,000, right? It's a lot of money, and
Yes.
most people don't really have that kind of money up front. So it really comes down to budgeting, right? You know how much money you make, and you know how much money your bills are. You know how much money your food is, your utilities, and all that stuff. So there's things you have to pay for, and then there's things you don't have to pay for, like entertainment and whatnot, right? So once you figure out what you absolutely have to pay for, and you know what your budget is, now you know what your mortgage payment can be. What if you're paying like $2,000 in rent, you know that maybe you can afford $2,500 for a mortgage payment. So if you can handle your car loan payment, your student loan payment, your line of credit, and your credit cards, and you know what each of those payments are, and you've done a budget, then you should be able to figure out what your mortgage payment is and whether or not you should pay off that car loan. Now, if you have a lot of debts and adding a mortgage is just going to increase your debt load, then yes, I would agree, pay off your debts first.
Yeah, for sure. Because that's what, that's what I encourage my daughter. Like, I know she'd like to save for a house, but I said, yeah, but you got such a high car payment, like how
Yeah,
do you do both, like, I mean, well, she's doing better than she was because her income is getting better as
good.
she works. So, okay, just all those questions are very important for people to think about. Like,
Yeah, yeah, absolutely.
before you even want to go to get a house, and is how important it is to sit down with the mortgage agent to discuss all these things,
Yeah, it's good to sit with a mortgage agent, even if you're like 1 year away from buying a house, because it's never too early to start thinking about how much money do you need to buy a house? What kind of income do you require? Do you know how much a mortgage would cost you? Like, do you know what interest rates are and all that kind of stuff? So arming yourself with that kind of information 1 year, even 2 years before you're ready to look for a house is a great way, because if you make $100,000 and you realize you need to make $110,000 for the house you want, well, that's helpful as you plan your career.
yeah, it's getting harder, I think, for young people to buy, isn't it? With the just because the cost of living is so
Yeah,
high,
absolutely. It's really difficult. It's also overwhelming, right? It's stressful, because you're buying this place you're going to live in, but it's like a huge amount of money that you're going to spend 25 years of your life paying off. That's a big commitment. And, we all have to have jobs and we all have to pay our bills. And if you have to live somewhere, instead of paying rent, you'd rather get a mortgage, right?
right?
You're investing into your future by paying a mortgage instead of just renting. But it's challenging, because if yeah, especially in Toronto, where I live in Toronto, so houses, like my own kids may not be able to buy a house here because of the prices.
Yeah,
So it's a big challenge, and it's good to sort of know well ahead of time how much a house costs, how much a mortgage costs, what your payments would be, so that you're not overwhelmed by the time you decide to buy a house.
right. And if you pass away, you still have a mortgage, and you got somebody's inheriting your estate, right? All of
Yeah.
that mortgage, whatever's left over, gets deducted from the sale of the home, right?
That's exactly right. So if somebody passes away and they leave a house to the beneficiaries, they will get the sale proceeds of the house minus all of the debts.
Right. So it's important. Well, and if you want to leave stuff for your kids, I always say, no,
You,
by
you
the time they're adults, they should be able to take care of themselves anyway. Don't
Yeah,
de-
but you know what? What it's interesting what you talk about. It's called generational wealth. It's this notion of, as each generation, evolves and grows and has kids and they have kids, the wealth that people have generated is passed on to family members to family members. So a lot of us who live in houses, by the time I pass away, the proceeds of my house may go to my grandkids,
Right.
because like, I've got a long way to go still, and I'm not leaving my house anytime soon. So, you know, we've been helped out by family members that have passed on who were two generations ago as well.
Very good. Yeah. Well, I think we'll end it there. I mean, this has been really, really informative, I think, and I think a lot of people are going to appreciate hearing all of this. And then we'll have you back on to talk about the reverse mortgage, because I think that's another thing that people don't quite understand. I know I don't.
Well,
Anyways,
I really appreciate you bringing me, Nancy. It's always a pleasure talking with you. I love talking about this stuff. So
thank you. Yes, and you're very knowledgeable, so I appreciate that too. So thank you very much for being here.
my pleasure.
And to the audience, thank you very much. You've been listening to Jason Wodlinger. Sorry, Jason.
That's okay.
Thank you, everybody, for watching the show. I hope you continue to do so. Take care, everybody, and peace out. Bye, Jason.